Well, good afternoon. Good afternoon. We're going to go ahead and get started. Shatika Husser here, CEO of Husser Financial Solutions, where we help you retire before you expire. So if that is you, we are the ones you hire. Our goal is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that we will not outlive. Welcome to the broadcast. I'm trying to pull you guys up so I can see you in the chat. And I'm definitely looking at some branding information here. We are right at 3 o'clock. Now, today we're going to do part 3. And the reason why we're doing part 3 is because we want to make sure that everybody's clear. If there's any questions, definitely you can ask your questions. Wanted you to also know that you can go to shatikahusser.com/life insurance. And there's literally a breakdown on all the different, insurance types, what they do and who the ideal client is for that particular type of insurance. So if that's something that interests you, you definitely want to take a look at that. So go to shatikahusser.com/life insurance. Hello over on Instagram. How you guys doing? Talking about part 3. Hi, William. Hi, DMA. Hi, M1 Pierre. And then, of course, over here on YouTube. All right, so let's jump right into it. So let's break it down to 3 types. So I want to get back to term one more time, talking about term. Term is, like we talked about before, temporary. Okay, most people do it to leverage to get more death benefit for their money. But I want to talk about 3 things that you need to have with your term policy if you're going to have a term policy. 3 benefits that you want to consider if you're going to have a term policy that does not come with a traditional employer term. Number 1, you want it to have return on premium. You want to get your money back. Okay, anywhere between 65 to 100%, you can get your money back. Okay, so ask about that when you look at your policy. Number 2, you want it to be convertible. You want it to be upgradable to what? A permanent policy so that you can take advantage of all of the different cash value and other types of benefits. Okay, so you want to make sure you take a look at that as well. So when we talk about different types of benefits, let's talk about that. Whole life has, and of course, IULs, the ones that we've been talking about, have the chronic, critical, and terminal illness. So if you have chronic, critical, or terminal, in other words, heart attack, cancer, stroke, dementia, those types of things, long-term care needs, it will actually take that into account, and you can use up to, depending on the carrier, anywhere from 80-85% or more, depending on the carrier, of your death benefit to be able to offset your medical bills. Now, you do have living benefits with your term as well. So I did not talk about that because there's only one carrier that I know of that does that. All right. And so you can have return on premium, get your money back, okay, up to 100% after so many years. And you can have the living benefits to be able to access, just like with a permanent policy. And you can also have it to be upgraded into a permanent policy. So you want to make sure that it is one that can be converted to a permanent policy. Okay. So if it can't do those 3 things, I would second guess it. I would take a look at it. I would, probably ponder over a little bit more. You want it to be, of course, competitive in the rate in which you're paying. You definitely want more death benefit for your money. So that's something to consider. So term is definitely one for the individual that is looking to be on a budget, but they want to make sure that they don't have a GoFundMe or have to sell dinners in order for somebody to be able to bury them, right? They want to make sure that they have something, all right? And so they want to be responsible. So that is going to be your least costly, a policy type of all of the policy types. Is going to be term, but it is going to be temporary. And so what happens is that the older you become, okay, the more expensive it is. So let's say you have a term policy on your government job, your good government job. We always talk about good government job. When you leave there, that term policy for the general, government job employee is going to actually go up. Okay, because you're tenured now. You're more senior than when you probably went in. And so normally that coverage comes down, okay, but you pay more money because you're older. So just take a look at that and ask about that. Ask your HR. Of course, I'm your HR bestie. So I know a lot about what you guys do in terms of that, in terms of your benefits. So just take a look at that, because generally speaking, it is going to be more expensive once you do come out, and try to retire. So term is usually rented insurance, meaning that you don't have that insurance whenever you leave, right? So, typical W-2 employee, when you leave your job, you don't have insurance. So that's why people get permanent policies. So if they want to go from employer to employer to employer, they get to own their policy. And oh, by the way, it is used for leverage. So if you wanted to get a loan, you can leverage what it is that you have going on in your policy in terms of your cash value for a loan, right? So it can be used as collateral. So that's another thing that people use it for. But the biggest thing is that people want to safeguard their money that's actually inside of their policy, because any lawsuits, you're not going to be able to take what's inside of somebody's policy that's built up. You can take anything else. You can take the employer plans, every other type of, commodity that a person has, but you cannot take what's actually built up inside of that policy. All right. So because the courts cannot see that. So that's what the wealthy do to protect. That's another way that they protect their money, not only from taxes and the growth of the money that's growing is tax free as long as you take it out as a loan. You don't take it out as a withdrawal. That's key. That's a key point to understand. Most people don't understand that. But of course, if you take it out as a loan and you was to expire and you don't pay the loan back, well, the money is actually just going to be subtracted from your death benefit. Okay. So we're talking about, of course, permanent policies. Now we transitioned from the term. We're talking about whole life policies, okay, or IUL policies. Those actually have the capacity to be able to have, take out a loan against whatever you have in terms of your cash value that's built up. Let's say it's an IUL though. You could take out a loan minus whatever your surrender charge is for the first 10 years. So understanding what your surrender charge is, so that you don't put too much money in and you say, oh, I want to take a loan out, but you can't because your surrender charge is a certain amount of money. So just understanding that so there's no negative surprises there. Now let's look at whole life. Let's transition because let's talk about all the different ways that people use whole life policies, how they use them. Okay, so definitely we talked about yesterday. We talked about banking, and we also talked about, of course, making sure that you can pay off your debt. So those were two ways that we talked about. But let's just deep dive into that a little bit more. So if you do have some type of debt, any type of debt, usually when you go to structure your policy, a lot of times people will ask you, or I should say the producer may ask you, what debt do you have? And the first thing that any producer should talk to you about, of course, is, what are all of your liabilities and what are all of your assets? You should do what's called a needs analysis. So a financial needs analysis should be done before you even write a policy, because we need to understand what your financial picture looks like before we can even really consult with you properly, to be honest, right? Because we don't know what your budget is. So two things that we want to know when you come to talk to us is, number one, what is your vision for your policy? And then number two, what is your budget for your policy? You have to have a vision for every policy, rather it's to flip properties or do real estate investing with the cash value, or, you want it for babies, education, what is it that are you trying to do $1 million baby? There's a lot of different strategies that people use for their policies, but understanding what the end is will tell us what policy to put you in, what policy type to put you in, and how to structure that policy. So you structure a policy, an IUL policy, a lot of different ways. It's a lot of different ways that you can structure that policy to get more cash value or more death benefit, depending on what the goal is, and then of course what your budget is. So once we know those two things, we can understand exactly which type to put you in. So let's talk about the banking. So people hear a lot about the banking and using policies to do that, because of course banks are not paying what we want them to pay, right? And most people want to have competitive. They want to have their money to compete with inflation. Because if you have your money inside of a bank account, you are becoming poorer and poorer every single day. So how do you increase your growth of their money that's in your bank account without having to, without having to worry about the risk? People don't want the risk, but they want the best of both worlds, right? So if you want the best of both worlds, some people are doing, banking policies basically so that they can grow their policy. So here's the deal with a whole life policy. Depending on the carrier, you can get anywhere between 2% and 6% ish dividend payout, right? If it's that type of a company, right? So you can have what's called a fixed interest. And then on top of that, you may or may not get a dividend depending on the carrier type. Some carriers have dividends, some carriers don't. So if the carrier has dividends, now you can actually get an additional. Now, I like to say this is just like paying taxes. You overpay in taxes, you get a refund. Same thing with a premium. You overpay your premium, you get some money back. Hi, Tay Jackson. I got to definitely get with you. So definitely want to make sure that we understand what that looks like, and really understand how can we structure that policy properly. I mean, that's really what we're talking about there. When it comes to banking, having a banking policy, people are more attracted to that because they want to be able to flip properties. They want to be able to pay off debt, rather it's paying off, credit cards or whatever. It's kind of like doing balance transfers, if you will, from one policy type to the next. So really understanding that, people are definitely taking a look at, how do I leverage my policy to be able to, one, get me better returns on my money so that it can grow, in other words, compounding, right? Because like Warren Buffett always says, unless you figure a way to compound your money or make money while you're sleeping, you'll be working for money all the days of your life. So you got to figure a way to do that. So that is one way, but it's risk-free, right? So to speak, right? Because there's no loss, right? Only growth in that whole life policy. That's one thing that people are looking at. And then, of course, depending on you wanting to pay all of your life or part of your life will determine how that policy is going to be structured, right? So 7 pay is going to be the most expensive because that is the least amount that you could, the least amount of years that you can pay on a policy. So you want to make sure that you take a look at the 7 pay option if you don't want to have to pay on your life, your whole life policy, all of your life. That's why it's called a whole life policy. So you literally will pay on it all your life unless you structure it to pay for 7 years or 10 years or 20 years, which is very doable, but you just have to be able to afford that. That's why the needs analysis is so super important to understand what is in your budget and how much can you afford to pay. Hi, Back Successful Life over there. And so definitely take a look at that. Now, besides that, looking at the whole life policy and how to structure that, and really understanding, all the benefits that you can get out of that. Number one, you got protection of your money from market volatility while your money is still going to grow. You have protection of your money from lawsuits. Okay. And now you're giving yourself a death benefit to be able to have what we call wealth transfer, right? And for some people, that's going to be, wealth transfer for generations to come, depending on how large that amount is. Okay. So some people, want to have a trust, and some people say, well, I don't need a trust. But if you don't have a trust, that's fine. However, it just depends on what you have. It depends on what you're trying to accomplish, because a lot of people use those for tax preservation and tax advantage strategies, as well as probate, challenges that they want to make sure that they take care of, right? So if you don't have a trust and you have yourself a whole life policy, at least the funds that's in that is tax free. Okay, the funds that the death benefit is always going to be tax free if you don't have a trust. But some people have both. So you can have the life insurance policy inside of the trust. Okay. And so they are partners that I have that I could, discuss that with you with, other partners to be able to help you to help with that if you need. But I don't particularly do trust myself per se, or, I don't, but I do have some people that I can refer you out to if you like. So, but definitely want to make sure you have that protection from, any type of, probate, and making sure that money can come out tax free for your beneficiaries is, really the biggest concern that a lot of people have. So really taking a look at that. And let's look at the index universal life. So we kind of did a comparison and contrast on the first 2 days, and this is the last day. So we want to see what other questions are out there. But when you look at the whole life policy and the index universal life policy, the ways that they are different is, you have number one, you get more death benefit for your money when you have the IUL versus the whole life. Okay. The whole life has a guaranteed death benefit. The IUL's death benefit is guaranteed based off of you having some type of cash value inside the policy, or, your cash surrender value has to be there, or else you're going to lapse the policy if you use too many loans, right? So being really careful with that. So most people will max what we call max fund up to the MEC limit, the IUL, so that they can make sure that it's growing. Number one, because it's going to compound at the rate based off of the S&P 500. It's going to perform based off of how well the S&P 500 performs, but it is not going to be tied inside of the market per se. Like, if you have your money in stocks or mutual funds, it's directly in the market. This is only going to parallel the performance of the market. It is not going to be directly in the market. So it parallels the performance of the S&P 500. So the S&P 500 crashes and has a negative whatever. We did historical data and looked at the last 40 years, 8 years was negative. Of those 40 years, then you would have been able to sleep. That's called, rest assured, you'll be able to sleep. That's sleep insurance, because you're not going to lose any money inside of your index universal life policy if you have a floor of 0 or 1, and those are the only two floors that are out there, right? When they say floor, that means 0 meaning that there's no loss inside of your account, but 1% meaning that you paid a fee to make sure that you have at least a 1% return even in years where the S&P 500 may have crashed. So that's what we're talking about when we say a floor of 0 or a floor of 1. Now, most people they're good with a floor of 0. They just don't want to lose any money. They're good with not having to lose. So when we look at the market and what happened in the last few years when the market crashed back in 2000, 2008, those years, those people that had index universal life policies, they basically locked that whatever they had inside of their policy, cash reserves, they actually locked in place. So those wealthy people were excited because they was like, wow, we're not going to lose anything. We're good to go, right? So it was able to sleep at night. So that's the wonderful thing about the IUL. You get to you get to participate in the growth of how the S&P 500 performs when it goes up, but you do not participate when the market actually crashes. So that you get the best of both worlds when it comes to the IUL, and that is why the wealthy love it, because they know they're not going to see what Warren Buffett said. He said rule number 1 and rule number 2 is to never lose money, right? When they ask him, what do you do as an investor? How do you do so well? Rule number 1 is to never lose money. He said, well, what's number 2? Well, go back to rule number 1 and never lose money. And that's why people love the IUL, because they're never going to lose money, but they're only going to make money over there. And so that's why they have IULs. The thing about the IUL is that it has been performing significantly well in the past few years. And of course, past results don't equal future results. And again, I'm not giving you financial advice. I'm not giving you a consultation right now. But what I am telling you is facts, is that, it's been doing extremely well for most companies. That you just want to make sure that you're with a company that's A-rated. Okay. When I say A-rated, Comdex score, AM Best, when you look at that, Standard & Poor, you want to make sure that rating is up there so that they can withstand a pandemic and maybe another pandemic, right? We want to make sure that they can be able to withstand any type of financial challenge and that their financial strength is there. And so how did they perform? How are they performing? And so there's some really good, IUL companies that are out there, their participation rates are anywhere, from 100%, 115% is what they're actually doing in terms of that. And there's actually an IUL company out there now that's actually giving you return on premiums, just like the return on premiums for a term policy. So that's pretty exciting to understand too. So there's only one that I actually know about as a broker, but yeah, so they've been around for some time as well and been doing extremely well. And they give you return on premiums if you don't, if you don't use it. Now, the thing about an IUL, just like, any other, insurance product, is after the surrender charge period, you can actually take all your money and go, and you don't have to keep the policy. You can just take the money and run, right? So year 11, if you decide you don't want the policy, it's yours, right? The whole life policy, you definitely have to pay on that and just keep paying on it. Is yours, it's a contract. Use or lose now. But either way, the flexibility of the IUL, let's get into that. So the flexibility of the IUL is going to be more of your ability. Let's say if you have some challenges financially because you lost your job or you were furloughed or whatever the case may be, you're not working the hours you were working when you purchased the actual policy. You could actually drop down to the minimum and just pay the minimum and still own that IUL. It's very, very flexible. Or you can just allow the, cash reserves that's built up in that IUL to go ahead and pay that policy off. So just understand that, right? So most people, what's better, life insurance, whole or Roth? I'll get into that. That's a great question, William, by the way, over on Instagram. Very good question. I'll definitely answer that. But the IUL is definitely going to be one that, like I was saying, just making sure that you understand that you can pay it off. And, let's say if you have bad situation going on and you can't pay your premiums, your cash reserves can actually pay your premiums. Okay. And literally that can be for years, depending on how much you actually have in there. Or you can just drop down to the minimum. You can structure the IUL to pay for 10 years, 15 years, however many years. But the wonderful thing about the IUL is you don't pay all of your life. You can pay for a certain amount of time, and you'll already know kind of what the projection is based off of historical data, what your income is going to be, what that cash reserve is going to look like, say at age 65 when you're going to retire. So if you need to take out a loan, what is that amount going to look like? Again, between the whole life and the IUL is going to grow exponentially faster than the whole life, because whole life is just fixed, and you hope to get the dividend payout. But the dividend payout is not guaranteed. It's based off of the performance of that carrier. Now, I'm going to answer your question, and I'll come back to the IUL because I want to make sure that since you're here, I want to answer it while you're here. Now, I've given a lot of different trainings on, or I should say conversation about that, the Roth IRA versus the whole life, or the IUL for that matter. The thing about it is you're talking about apples and oranges, so to speak, right? So I can't say which one is better. I have to know your total financial, what you have going on financially and things of that nature, based off of the Roth IRA being a taxable vehicle, or non-tax vehicle, I should say, because already, but you've already paid the taxes on that, right? The whole life is the same thing. It's going to grow tax-free. But what are you trying to accomplish? I guess I'm assuming it's some type of retirement account, because you're talking about a Roth. So the whole life is actually, it is what it is. It's something that you're going to pay on your entire life. A Roth IRA, once you're done paying, you're done paying. That's the one thing. You're not paying on it all your life, unless you structure that whole life to be a certain amount of years. You're going to pay for it forever. Okay. And it's going to grow at a fixed rate, right? So it's probably not going to grow like the Roth IRA, right? But the whole life is going to grow tax-free. And of course, the Roth is well, because you already paid the taxes on that as well. However, you don't lose money in a whole life like you will in a Roth IRA. And a Roth IRA is pretty much a mutual fund, right? The expenses are going to be generally higher. So about 30 to 50% is what we've been seeing with an IRA versus the whole life, right? So from a fee perspective, you have that going on. And then, of course, you can lose your funds, right? In a Roth IRA, if the market crashes, you can have a loss in your Roth IRA as well. So there is no protection with that. So the whole life is going to have the protection of market volatility, but it's just going to be a fixed amount. So we need to understand, what is your risk tolerance, right? So if your risk tolerance is, high, maybe you want to go the Roth IRA route because you're okay with, possibly losing money and making it back in your lifetime, you hope, right? Because a lot of times people don't make their money back in their lifetime. So that's the biggest challenge there. Will you make, so the younger you are, the more risk you can absorb. The older you are, the less risk you should be having inside your retirement portfolio, right? So trying to take that risk away. Ideally, 25%, or less, the older you are, closer towards retirement. But everybody's different, right? So just understanding what your risk tolerance is. Roth is going to be riskier than a whole life, of course, but it's going to grow. And you're going to end up paying taxes later, right? So state and federal taxes, you're going to end up, no, not on a Roth IRA. No, not on a Roth, but on just a traditional employer plan, you would. So just understanding that, but they're limited on a Roth, right? So how much money you can put in that, $6,000 a year, right? So your whole life, you depending on your death benefit will determine what your premium is going to be. So the higher your death benefit, the more premium you can put in it, the more money you can get out of it, right? So there is a fixed amount that you can put inside of the Roth, though. And of course, in the whole life, you have your whole life to be able to have those funds there, where you got minimum distributions on a Roth IRA, right? So at 70, 72, you got to start taking that money out. Okay. Whole life is yours. You can do whatever you want to do, and you can use for whatever. There's less restrictions. So if you're looking for flexibility, I would say being able to access your fund, being able to control your money, having a living benefit attached to it, having a death benefit attached to it, then that's definitely more significant than a Roth IRA, right? So let's just say you put $400 inside of your whole life and $400 in a Roth IRA, and you're doing that every month, and you've been doing that for, let's just say 6 years or 6 months. What happens when you pass away? How much money are they going to get, right? If you have a whole life policy, you might have a $400,000 death benefit attached to that whole life, right? And your family or your beneficiaries can get that $400,000 versus, the Roth IRA, they're not going to get anything if something happens to you, right? If you become ill, heart attack, cancer, stroke, dementia, have some type of long-term care challenge, you can access, up to, let's say if that is a $400,000 death benefit, you can access up to 80% of that, $320,000, to be able to pay off your medical bills and not have to go bankrupt in your lifetime, right? A Roth IRA, oh, well, sorry, what you have is what you have. And then we're going to tax you on top of that. We're going to penalize you on top of that. So you got to look at all of the different scenarios when it comes to that. Whole life definitely can be a bank, right? So if you need money, you don't have to worry about taking that money out and using it for what you need it for, as long as you put it back, right? So those are some of the things you have to just kind of think about. Hopefully that answers your question. We can probably keep talking and have more dialogue about that. But yeah, good question over there. So IULs definitely is one to take a look at if you are looking to get your cash reserve and your income. So I like to say that, you have to design your own Social Security. We don't know if Social Security is going to be around 2025 to 2032. Economists are saying Social Security is not going to be around. So if that be the case, what are you going to do, right? You hope it's around, but how do you supplement that, right? So an Index Universal Life is going to help you supplement your Social Security. Basically, you're taking care of your older self. Nobody likes to think of their future or dying. And I know it's kind of like a morbid conversation, so to speak, but I mean, you're taking care of your older self. You hear people talk about self-love all the time, self-love. But if you love yourself, start, figuring out how you're going to take care of your older self. And that's how people do it with their retirement accounts, right? Or the IUL. Just making sure they have a stream of income. With inflation, that's going to keep in touch with or in pace with inflation. We haven't even talked about annuities. So let's just pause there. I'm going to be talking about annuities next week, because nobody really knows a whole lot about annuities. And if you can't get, let's say, life insurance, you can get an annuity, and it is going to keep pace with inflation. Okay, the only thing about annuity is that it's going to have, of course, taxes, right? So where the whole life doesn't. So we want to make sure that we are doing that, right? We're looking at the annuities and how does that grow. You can do illustrations and you'll be pleased with the growth that you see in an annuity. And these are contracts, so they have to perform, right? Based off of what they say they're going to perform, or you don't lose any money in an annuity. You can lose money in a Roth IRA. You can lose money in, your 401k, your 403b, your 457, your TSP, your IRA, your SEP IRA for the business owners. You can lose money in all of those things, right? But you cannot lose money in annuities that we structure, which is called a fixed index annuity. A year, what is the max contribution you can make to an IUL? Good questions over there. It depends on your death benefit. So your MEC is your max contribution that you can put inside of your IUL. So you need to understand what your MEC limit is, or MEC, Modified Endowment Contract Limit. So with the IUL, you essentially get money going to a savings account that grows based on the market, and you get a term life policy. Well, you get a regular, it's a permanent policy, but you can add term inside of an Index Universal Life. And a lot of people do because they can't afford, because it's a permanent policy, they cannot afford to pay that amount of coverage for death benefit. So if your death benefit is $1 million and you can only afford to pay $700,000 IUL, then maybe you do a term for the other $300,000 portion, so make sure that you have enough coverage. So you can be structured that way too. So good question, Kay Gaddy. How you doing? All right. So yeah, some good questions over on Instagram. But so let's just take a look at that, because the IUL is definitely one that people are using to leverage in so many ways, right? So people are, like I said, paying off. You can pay off debt just like you can pay off debt with your whole life, but it's going to take you a little bit longer because you got those surrender charges in there, right? So just being clear about, what is my surrender charge? How much can I actually take out the first year, the second year, the third year, and based off how it's structured. If you have what's called a B increase in structure, meaning that you would start off with a very small death benefit and it will grow over your life for the IUL, then you're going to have, some cash value buildup. And with that cash value buildup, something was to happen to you, your beneficiary is going to get the death benefit and that cash value, however that grew, right? So they're going to get both. But in just the regular structured Index Universal Life, they're only going to get what's called a level. They're only going to get the death benefit, right? Minus whatever the loans are that you actually took out. So good question over. So let's see. Any other questions over here? All right, because I'm definitely at 30 minutes. I always say 10 minutes every time I get on here. But I just wanted to answer any questions you guys have, kind of wrap things up. And just to let you know that I'll be talking about annuities, definitely DM me or message me on what questions you want me to answer as it relates to the annuities, so I can make sure that we get you some answers for that during next week. And I also want you to know that you can download your free retirement planning guide at shatika.com. And also want you to let me put that on the banner over here. Yeah, let's see. Let me put that over here. Now, and then I also want you to be able to take a look at shatikahusser.com/life insurance, so that you can be able to see what it is that, we offer in terms of insurances, right? And what they mean, what the criteria is. I'm going to see if I can pull it up. And if you can see what I did on a PowerPoint really quickly, if I can add it to the thing here, so you can kind of see without me having to go straight to. All right, let's see. I am going to do this. I'm only one over here. And then add. It's been a while since I tried to use a presentation mode on here, but it's not working. Oh, I see now. Let's see here. So I want you to be able to see that we do have different types of insurances on our website. So if you want to go and take a look at that, and it'll basically show you what those insurances are, and what the ideal client would be for those, right? So if you had questions about it, and if you fit those molds, you'll be able to see that. So that's really what I was trying to pull up, but I'm a little technology challenged right now because it is not coming up. But let's see if we have any questions. If you guys have any questions over here on YouTube. Anybody over here? Okay. Well, that's all I have for today. I never want to be long. I just want to be strong. I just want to give you the information that you need and answer the questions. I could re-answer them if I spoke too fast. I asked because I think going to line is a better option than Roth. Yeah, I think your money is better. Okay, so yeah, I asked because over here on Instagram, they said I asked because I think going the life insurance route is a better option than a Roth IRA. I think your money is better protected and can earn an equal ROI. Yeah, so everybody has their opinion. Of course, there is no aim. It's the Roth IRA works for who it works for, right? So it just depends on, like I said, the vision of the person, the goal, what you're trying to accomplish, and what your budget is. And that's all of this, right? So we just want to know, what is your financials? What does that look like? And then we just want to backward plan from there, right? So for some people, they rather be more aggressive. They rather, go outside of the insurance product and do stocks for what it is that they're trying to accomplish. Other people say, they want to take the risk away, but they want to make sure that they have all the benefits of the living benefits. They like the living benefits and the other riders that you can attach. I don't know. We rarely talk about the other riders, but there's a lot of different types of riders that you can attach to your life insurance policy. We haven't even gone over any of those. But depending on what you're trying to accomplish, there's some riders that can be attached to that as well. And yeah, so William, I get it. Some people definitely love it. Some people hate it. It really is about the individual and personal preference, right? So it's very subjective. And I'm just here to understand, what it is. And if you can come with a clear vision, I think that's the fair thing to do to anybody that you're working with, no matter who you decide to work with. If you can be clear on your vision, so you don't go back and forth. Oh, I want to do cash value policy. No, I want to do death benefit. No, I want to do a banking. I want to do a debt. You need to be clear on what it is that you need to do or would like to do with your money. And then the only thing we're going to do is just make it happen for you. You know what I mean? It's not about any other type of agenda, but your agenda. The customer comes first. The client comes first. Your vision comes first. Making you happy comes first. Right now, I have 100% client retention. Okay. And I met with quite a few clients, right? So right now everybody's fine with where they are. Sometimes clients they do have questions, they have challenges, they want to ask more because they go and they talk to these other people, and this industry is very cutthroat. So a lot of producers trying to take your clients, and they come back to me and they say, well, they said this and they said that, and I just educate them. Only thing I do is educate, right? So my goal is to educate you as much as possible, and then let you make the decision. I'm not trying to sell you anything. I just want you to get all the facts, and based on the facts, you can make a decision, an informed decision. And when you don't feel peace, then you don't need to buy. I don't want you buying anything without feeling peace, because you're going to be a person that come back and say, I don't want it again or something. I need you to know before you move forward that that's what you want to have. I don't pressure anybody. I mean, it's not that serious. So, and this is a big decision, right? It's kind of like buying a house. When you look at how much paperwork you got to sign, this is real. This is a real deal, right? So, I actually have, like I said, 3 different types of policies, and they all serve different purposes. So, really, just understanding, what is your end goal, and what you're trying to accomplish. So, hopefully, I answered everybody's questions. If there's any other questions, let me know. But again, annuities is what I want to talk about, because you guys can't sleep on annuities. Take the risk away. Take the risk away, and design your own, lifetime income with an annuity, especially if you can't get insurance because of your health. And they even come with well-being riders. They come with bonuses and all types of stuff. I don't want to start talking about that because it'll make this longer, but I love talking about annuities. So yeah, if you have any questions, ask me and I'll definitely get back with you. God bless you. I am Shasika. I am going to end this live. If you need help with retirement, life insurance, annuities, I'm your girl. All those other things, I can talk to you about it. I got real estate, I got cryptocurrency, I got all that stuff, but I'm a multi-dimensional investor. But I love life insurance because what it does. So everything that I've been, contributing my money to, I'm very, very pleased with what I'm seeing with the life insurance product and what it can do for you, and how you can leverage it like the wealthy have been doing for so many years. And who knows how to invest your money, better than, or at least, structure things and grow your money like an actual carrier. That's why the banks turn to carriers. That's why they have bank-owned life insurance. So why not get involved like they get involved? Do what the banks are doing. Whatever the banks do, you do. I remember I was learning how to trade Forex. The banks do Forex. So I was trading Forex, right? And I still trade Forex when I want to, right? So whatever the banks is doing, trust me, that's what you need to be taking a look at, because that's how you leverage. That's how you grow your money. And I know you guys know, I'm a recovery. I should say I was doing a lot of real estate investing, and I'm getting a lot of people trying to purchase property from me, and I don't want to sell, right? So I'm definitely going to leverage what I have. But when I want you guys to be careful with these loans, that these refinance loans. So just be real clear about it. You don't need a loan if you can help it. You want to get a HELOC, home equity line of credit. I just want to say that I want to give a little bonus here, a little bonus. Do the home equity line of credit versus doing the loan, because you don't have to stop paying the payment back. You don't have to stop paying the interest back. Or you only what you use is what you're going to be charged on, right? With a home equity line of credit. If you have a loan, as soon as you take the loan out, you're going to have to. You're welcome over there. As soon as you take the loan out, you're going to start having to pay that back, right? And that's already putting your debt to income over. So don't do that. Do a home equity line of credit, right? So I don't know if a lot of people understand that. So before you start trying to take out a refinance, a loan, and stuff, and all this kind of stuff, and putting yourself further and further behind, just do a HELOC. Use what you need, and pay it back. All right, I'm done. God bless you. Have an amazing day. Have a great weekend. Hopefully everyone's gonna do something fun this weekend, and get out and do what you do and enjoy your families, because life is too short. All right. God bless you. Talk soon.